Hello everyone. This is the last video of this chapter, and in this video, I'm going to discuss capital market efficiency. If you have read the chapter so far, you have noticed that capital market history suggests that the market values of shares and bonds fluctuates widely from year to year. So why does this occur? At least part of the answer is that prices change because new information arrives, and investors reassess asset values based on that information. The behavior of market prices has been extensively studied by academic researchers. A question that has received particular attention is whether prices adjust quickly and correctly when new information arises. Okay, a market is said to be efficient if this is the case. Okay, so to be more precise, in an efficient capital market, current prices fully reflect available information. By this, we simply mean that based on available information, there is no reason to believe that current prices is too high or too low. Okay, the concept of market efficiency is a rich one, as much has been written about it, and a full discussion is beyond our course. However, we will briefly learn about this. Okay, so you can see that efficient market hypothesis has these three key components. One is stock prices are in equilibrium. Stocks are fairly priced, so they are not too high or too low, and the market is information efficient. That means all information have been reflected already in stock prices, so that you cannot earn any abnormal or excess return by exploiting any past information. Okay. The efficient market hypothesis, EMH, asserts that well-organized capital markets, for example, ASX or NZX, are efficient markets, at least as a practical matter. In other words, an advocate of EMH might argue that while inefficiencies may exist, they are relatively small, uncommon, and impossible to identify systematically. Okay, so a test of efficiency is that investors cannot systematically use publicly available information to profit by outperforming the market. Okay, so if a market is efficient, there is very important implication for market participants. All investment in an efficient market are zero NPV investments. The reason is not complicated. If prices are neither too high nor too low, then the difference between the market value investment and its cost is zero. Okay, hence the NPV is zero. As a result, in an efficient market, investors get exactly what they pay for when they buy securities. Firms receive exactly what their shares and bonds are worth when they sell them. Okay, then what makes a market efficient is competition among investors. Many individuals spend their entire lives trying to find mispriced shares. For any given share, they study what has happened in the past to the share's price, and in dividends, they learn to the extent possible what a company's earnings have been, how much it owes to creditors, what taxes it pays, what businesses it is in, and so on. Not only is there a great deal to know about any particular company, there is also a powerful incentive for knowing it, namely the profit motive. Okay, if you know more about a company than other investors in the marketplace, you can profit from that knowledge by investing in that company's shares if you have good news, and by selling it if you have bad news. The logical consequences of all this information being gathered and analyzed is that mispriced share will become fewer and fewer. Okay, in other words, because of competition among investors, the market will become increasingly efficient. Okay, and a kind of equilibrium comes into being where there is just enough mispricing around for those who are best at identifying to make that for a living. Okay, so that's the main idea of efficient market hypothesis. So all new information are reflected already in the stock prices and investor trade on them. We already discussed this point in the last slide. Now, some common misconceptions about the EMH. Look, no idea in finance has attracted as much attention as that of efficient market, and not all of the attention has been flattering. Okay, rather than rehash the arguments here, we will content to observe that some markets are more efficient than others. Okay. Having said this, it is the case that much of the criticism of EMH is misguided because it is based on a misunderstanding of what the hypothesis says and what it does not. Okay. For example, when the notion of market efficiency was first publicized and debated in the popular financial press, it was often characterized by words to the effect that throwing darts at the financial page will produce a portfolio that can be expected to do as well as any portfolio managed by professional analysts. Okay. Confusion over statements of this sort has often led to a failure to understand the implication of market efficiency. For example, sometimes it is wrongly argued that market efficiency mean that it does not matter how you invest your money, because the efficiency of the market will protect you from making a mistake. However, a random dart throw might wind up with all of the darts sticking into one or two high-risk shares that deal in, say, genetic engineering. How would you really want all of your money into such firms? Okay. The message being that care should be taken in building portfolios, even in an efficient market, so should not be done by throwing darts at the financial page. An important implication of market efficiency for corporate finance is that the price a firm will obtain when it sells a share is a fair price, in the sense that it reflects the value of that share given the information available about the firm. Shareholders do not have to worry that they are paying too much for a share with a low dividend or some other sorts of characteristics, because the market has already incorporated the characteristics into prices. The concept of efficient market can be explained further by replying to a frequent objection. Is it sometimes that the market cannot be efficient because share prices fluctuate from day to day? If the prices are right, the argument goes, then why do they change so much and so often? Okay, so from our understanding so far, we see that fluctuations in share prices are in no way inconsistent with efficiency. Investors, with the information every day, try to trade on that, so prices are fluctuate. So these are reflection of those information flows. Okay. However, many would argue that share prices are more volatile than is the fundamental value of the firm, as indicated by, for example, dividends, earnings, and so on. So to conclude, efficient market hypothesis means that you will earn a return that is just to compensate your risk, okay? And you cannot exploit past information to earn abnormal return consistently, okay? And market efficiency will not protect you for doing wrong, okay? For example, investing in only one or two shares instead of diversifying them. There are three forms of market efficiency. They are weak form, semi-strong form, and a strong form efficient. Okay. Starting with extreme case, if the market is a strong form efficient, then all information of every kind is reflected. Okay, this is what I'm talking about. All information of every kind is reflected. In such a market, there is no such thing as inside information. Okay, inside information means it's information that is known to the management, okay, and that is not known to the outsiders. Okay. So we are apparently assuming that all information that can be produced are reflected in stock price in an efficient market. Okay. The second form of efficiency, the semi-strong efficiency, is the most controversial. If a market is semi-strong form efficient, then all public information is reflected. The reason this form is controversial is that it implies that security analysts would try to identify mispriced shares using, for example, financial statement information are wasting their time because since financial statement information are publicly available, that are already reflected in share price. Okay. The third form of efficiency, the weak form efficiency, suggests that at a minimum, current price of share reflects its own past prices. Okay. In other words, studying past prices or volatility in an attempt to identify mispriced securities is futile if the market is weak form efficient. With this form of efficiency might seem rather mild. It implies that searching for patterns in historical prices that are useful in identifying mispriced shares will not work. So we already discussed this point. Just I will add a couple of points that the empirical literature, for example, about strong form efficiency, the empirical literature has indicated that markets are mostly not strong form efficient, and insiders typically have opportunity to earn abnormal return utilizing their access to inside information. Semi-strong form efficiency means publicly available information cannot be used because they are already reflected in stock price. Okay. However, inside information can be used to earn abnormal return. And weak form efficiency, as I already indicated, that looking at past returns and volatility and developing some technical trading strategies will not allow you to earn any abnormal return. So that's essentially the end of our discussion on market efficiency, and that's the end of this chapter 2. So in the next video, we will start discussing chapter 11. Thank you very much.